If there is a shutdown, what does it mean for currencies, for the dollar?
Well, you know, the only kind of template we have is the 16-day government shutdown in October 2013 when under the Obama administration. Back then, it wasn't huge. You know, we had a 1% drop in or around the start of the shutdown period, but by the 16th of October of that year, the move had reversed. So, you know, broadly speaking, there wasn't a significant dollar impact. What's different this time around, though, is back then the Fed's policy stance was ultra easy, and Ben Bernanke had just delayed the end of quantitative easing, or the beginning of the end, and conditions were very favourable. Of course, on this occasion, we've had 5 rate increases. The market is 80% priced for a move in March, and I think if we do go into a government shutdown, perhaps not immediately, but obviously if investors start to get concerned that this could drag on and become a longer one than the one in October, doubts over that rate hike in March, I think, will come into play.
Derek, we're going to touch on this all through the morning, and I guess it comes into this politics affect the dollar. But the fact is the chart is ugly. Is there any way you can model that we get dollar weakness back to where it was in 2004, before the latest dollar boom? Well, I wouldn't expect that extreme a move this year. We had a 10% drop last year. We're expecting something in the region of 5 or 6% this year. Okay, admittedly, we've already had 2% nearly since the start of the year. So momentum certainly dictates that it could be more than what we're expecting. But, you know, there are, of course, some differences. And I think in that context, the backdrop is negative.